Hey, what's up? This is Odulena from Odulena Digital. Welcome to my channel. Today is book review day, and as I've been following the last few weeks, I'm going to my favorite book from favorite writer Thomas Sowell, Economic Facts and Fallacies. And today I'm talking about the income facts and fallacies. If you're new here, please be sure to subscribe. There will be a lot of such videos, and also you can check my whole playlist in Thomas Sowell, because I really admire this writer. This topic is actually very important and very passionately discussed in media and politics. A lot of strong opinions, and the whole chapter starts with a quote which I really like, is that it's very easy when it comes to statistics. It's like Olympic figure skating. It's very dangerous, there's a lot of leaps and twirls, and nearly not as easy as it looks like. This is kind of income statistics. However, there is also a topic which inspires many people to form very strong opinions about very weak statistics. And Thomas Sowell proves it very well, as usually. Some of the information is a little bit outdated, so I'll include some newer statistics, but if you know something that is currently published and it's adding more to this discussion, please comment below. So the first fallacy, when we look at the incomes in the United States, is that there is, except for the rich, everybody else's income has been stagnating over the years. So there have not been increases for the poor and the middle class. So here there is one important thing when you look at income statistics, is whether this is per capita or per household. A household is everybody who lives in the same house or an apartment, and their incomes are combined together to form a household income. Therefore, this is tremendously important how many people live there, how many of them are employed full-time and part-time. So sometimes a household with a lot of people, where a lot of them are working, might seem that they have a huge household income, but they might not be living very rich lifestyle. Same that a household where you have one top earner and a lot of people who are not working, it will have per capita lower income. This fallacy, his exact example here is from 2007, when comparing Black and Hispanic household income. The Hispanic household income looked stronger than the Black. However, there were more people per household in Hispanic household, and more of them would be working part-time or full-time. Therefore, this skewed the income, and when you compare both of them, it's very difficult to say who is better off. Then, another big fallacy, a lot of these statistics takes income before tax. So when you look at actually income and income brackets, these are income that are not net income. This is income before tax. So if, let's say, $100,000 to $150,000 tax income, this is before taxes. And of course, as you earn more and more, your taxes are bigger and bigger, and higher percent of your income is taxed. So which skews a little bit the statistics and kind of over exaggerates the incomes of the people who are on the top versus the incomes on the bottom. Similarly, a lot of these taxes are taken for different social security programs which are available to people in the lower tax brackets. And these are also not mentioned into such statistics. So kind of it shows that the poor are extremely poor. They're not showing the fact that they have access to social security and different opportunities to get income, whereas the rich and the higher income brackets are presented as extremely well earning without taking into consideration that they are heavily taxed. Another important part is that a lot of employees now do get other benefits apart from salary. So salary used to be the only thing that employees were getting in the past, but now there's pensions, there's social securities, there's all kind of different benefits like insurance, life insurance, travel insurance. Some companies give you dental insurance, some company gives you equity, stock, different bonuses, as well as other packages like saving accounts and ERA for 401k account. These are not counted towards the total compensation. So it's very important to look at income, not just the salary, but the total compensation. And if we take into the total compensation, if it's very likely that the incomes of people have been increasing significantly because of these additional benefits that they've been getting from their jobs. Then another important part is looking into inflation. Inflation can be very easily exaggerated, especially because it is based on something called consumer price index. Consumer price index takes the cost of goods over time and compares how much, let's say, milk cost before and now how much it costs now. However, it does not take into consideration that the products of the past are not the same as the products of now. So if most people maybe now are buying not natural milk, they are buying some vegan replacements which cost more expensive. Or look at cars from 1960 and cars from 2021. Like in the 1960s, even having a radio would be a huge luxury, whereas now every car comes with a Bluetooth, with a GPS, with navigation and all kind of technology already built in. So these are already superior products and therefore they cost more money. So this can make it look like the prices are increasing. However, also the quality of the products is increasing, as well as other products which we did not buy before are entering our life as their prices become affordable over time, like laptops, computers, and now gradually you can see wearables, smartwatches, and other devices are starting to come into popular demand and people have more and more access to them. However, these products are not considered into the consumer price index until they are cheap enough that everybody has them. So this decline in prices is not really reflected into consumer price index. Fallacy number 2. Over the years, the poor are getting poorer and the rich are getting richer. This has been quoted multiple times, and I don't like this rule because first it overestimates how the rich are richer and underestimates what's available to the poor people. Second of all, it somehow implies that the rich are getting richer and they are deriving their wealth from the poverty of the poor, which is not the case, especially not in the United States. When we look at the definitions again of who is poor and who is rich, you can see that there are some problems and fallacies. So often the definition is purely annual income per capita. And the annual income per capita can mean something, but it does not always mean that this person is poor or rich. Imagine someone who is a very successful entrepreneur and investor and they had a terrible year and they haven't earned anything. Let's say they are on a minus, their income is very low. However, they have millions and millions invested in the market, maybe they have millions tied up in different companies that they have. So actually this is not a poor individual, but according to the annual tax return, they will look as a poor person. Same as, let's say, the darling of someone who is very wealthy. She might be working some kind of job which is paying a little income. However, she's not considered to be a poor person because of the resources that are available to her. Same as children of wealthy parents who are maybe living at home with them and doing a voluntary job or working for a very low salary in a charity organization. They are not poor people, but their income is low. Same as, imagine recent graduates who just started their first job and they have worked only half of the year. So next year their income is going to double. So defining the rich and defining the poor is very difficult. Same as defining the rich. When you look at taxes on the rich people, very often the top 20% of the Americans is actually people earning over 80K or people earning over 100K. Nowadays, this is the most updated one. In 2006 was over 80K, which is, let's say, a high income, but you would not say that this person is really rich. Maybe 100 to 200K per year. It's a comfortable and strong income, but I would not say that this person is rich and wealthy. When we're looking at the top and top of top, we're looking at the wealth, not the annual income. And a lot of these top percent people will have wealth that is stored somewhere else. Maybe they're tied up into companies, into stocks, and their actually annual income is not as high. So it's very difficult to define who is rich and who is poor. You might be looking at some middle class people who are earning a strong income, but they have a lot of expenses. So actually what is available on their disposal is not that big. So they're not considered actually rich, but according to statistics, they are totally in the richest 20%. And finally, there is mobility. So not everybody who is poor is going to be poor forever. And actually, very few, statistics shows that very few of the people who are in the lowest bracket end up in the lowest bracket in the next 10-15 years. People who were in their 20s in 1986, increasing their income by 91% over these years, from 1986 to 2005. Because these are young people, they get more skillful, maybe they start their own business, they grow up in their company, and of course their incomes increase, even though they may have started with the bottom line. Same as when you look at people in the poverty, let's say the lowest tax bracket. A survey done 1975 showed that 3/4 of the people who are in the lowest bracket ended up in the top 40% over the next 16 years. So actually people move, and this is a normal process. When you start a first job, when you start your business, when you are just beginning, maybe you have a difficult year, but this doesn't mean that it's going to be forever. And the same for the rich ones. A lot of rich people maybe had a lucky strike, maybe they got an inheritance, or maybe they received some money that they cashed out from investment they've made. And over the next years, maybe they were not so successful, so they may end up into a lower bracket. So these are moving. We always imagine the rich as like some kind of princes in castles and the poor living a horrible life. But it's not always the case. When we look at the Forbes, the 400 richest people in the United States, in 2006, only 2% of them actually inherited their money. 98% of the Forbes on the list were actually people who made their money in their lifetime. This is all from me for today. Thank you so much for watching this video. I hope you enjoy it. Please give it a like, comment, share, and subscribe to this channel if you haven't done so already. Explore the rest of the videos, and I'll be back with a new video next week.